Okay, video 2 of our series on the acronym TREND. The first T stood for trouble. The R stands for recession, but it's actually a revenue recession. What do I mean by that? Well, we just got through another round of Wall Street corporate earning reports, and you always focus on two things. They always tell us about earnings per share and revenue. So what we're seeing more and more and more, we've actually started seeing this in the middle of last year, 2015, is a company would meet the earnings per share or exceed it, but they would miss the revenue. So how does that work? Well, before we jump into this, let's go back to a household example. Let's say that you bring in $10,000 a month and your expenses are $9,000. Okay, so you're good, you're saving money, and everything's great. So if you divide 10 by 9, that's going to equal you a 1.1% ratio. But what happens if your revenue, your income, goes down to 9,000? All of a sudden, if your expenses remain the same, you are barely above water. So you don't want to be in that position. So you cut cable and you cut some other expenses, maybe eating out so much, and you reduce your expenses down to 8,000. So you're back to this positive ratio of 1.11. But sure enough, income goes down again. What do? Well, we do something drastic. Let's say we are able to, because of interest rates, refinance the home. So we're able to shave $1,000 off our expense because we refinance the home. But unfortunately, bad news comes again. Our revenue goes down to 7,000. And we're at this ratio. But then again, revenue goes down the next month to 6,000. What do you do in these two scenarios where your income just keeps going down? You can only do so much to your expense side. What happens to you? Well, corporations actually have something available to them that you don't, and that is they can do some financial engineering along this line of earnings per share. So this line here, this is your revenue, and then the earnings per share in this example is your expense item. So earnings per share is a company's net income. This is their revenue minus dividends on preferred stock. So it's net income divided by, not shares, outstanding shares of stock. Okay, so let's just take a quick example. Let's say the net income is $20 for a company and they have 7 shares outstanding. So their earnings per share would be $2.85. They have $2.85 of earnings per share of stock. Now, if revenue goes down, this number here, this net income revenue goes down, then all of a sudden this earnings per share is going to go down dramatically. So what can Wall Street do that you and I can't do? Well, it has to do with this number right here, their outstanding shares. They can do what's called a buyback. They can simply go to the market and buy shares back. And at these low interest rates, the capital required to doing that, the cost of it is very minimal. So let's do the math here. Let's say they just buy 1 share back. They buy back 1 share, so there's 6. Well, 20 divided by 7 is 2.85. 20 divided by 6 is 3.33. See how that math works? This is how Wall Street has been able to make people happy when their revenue's going down, yet they can make their earnings per share go up by doing what? By simply buying back stock. And you can thank our Federal Reserve for keeping interest rates low that allow them the basically free capital to do that. But how long can this really go on, right? How long can this go on? How long could this go on in your household? That's the real question. And that's why I want to point out this revenue recession, because we're in a revenue recession, and if this can't go on forever, ultimately a true recession in all capacities takes hold. So let's take a look at a chart by Albert Edwards, head of Societe Generale. Now he's an admitted bear, but let's look at this chart. This is the labor market conditions index on a cumulative basis. So anytime you see a gray bar, that's a recession. And whenever you see this blue line, this is the cumulative index. Whenever it reaches a peak, you can see the peaks here. Whenever it reaches a peak within 9 months, on average, a start of a recession begins. So you can see this is 2000, This is the big one. This is the crash in '08. And here is our peak here. So we peaked 4 months ago. So in an average, if it takes an average of 9 months, the distance from this peak to this start of this gray line, distance to this peak to the start of this gray line, if that average is 9 months, we're already 4 months into this peak. Now, could this number turn back around like it did here or here? Well, sure it could. Anything can happen. But as you're going to see in some of the later videos, there's just too much wind against us to prevent this avoidance of this. Let's take a look at another chart. This compares the S&P composite over the Shiller price to earnings ratio. And there's a lot of legitimate economists that look at this and determine that during long-term equity downturns, there are 4 recessions that you have to work through before you reach your bottom. So our peak was in 2000. But if you look in the past, on average, you can see these time periods over 19 years, 16 years. These are the recession periods. You can see the declines, 70%, 67%, 62%. This had 6 recessions. This had 4 recessions. This had 4 recessions. Anytime you see this little red area, that denotes a recession during this down period of time. We reached our peak in 2000. And guess what? We've had 2 recessions. Well, wait a minute. If the average is 4, and we've already gone down 60%, you can see some of the other declines. If there's an average of 4 recessions in a long-term equity downturn, we've only had 2. That means we should, on average, have 2 more. And if we've already had a 60% decline, that means with 2 more recessions, we're going to have real pain in our future. So Wall Street has proven that they can fight and claw thanks to the Federal Reserve providing free money, this casino type money. But we're going to talk in these other letters how I believe that some of this stuff is coming to an end. And we will bring this video to an end. So keep an eye out for the videos coming up, and always go to Brinkman Academy to watch other insights. Thanks for watching.